Welcome back to our Retirement Basics series. My name is Greg Parker, managing partner here at Engrave Wealth Partners. And thanks for joining us today as we dive into Retirement Basics number 5. Folks, we've been talking about the tax problem in retirement. And thinking about the tax problem in retirement, I remind you this because everyone who has saved diligently for retirement in the form of a pension or a 401k savings plan is going to recognize that taxes are going to be their largest single expense in retirement. Why? Because most of the investments you've made in a 401k or a pension are tax deferred investments. That simply means that the taxes that you would normally owe on the income in those investments is going to be assessed at a later time. And as we talked about back in Retirement Basics number 2, the idea of when those taxes are paid and how they are paid is going to depend upon how you choose to take money out of your retirement savings. Folks, if you've never looked at this from a personal level, built your own personal retirement analysis, I strongly encourage you to engage with us and allow us to build out that free personalized retirement plan analysis so that you can know exactly what your tax liabilities are going to look like and how to implement some strategies that could encourage some tax savings. Folks, tax savings are going to be critical as we move forward where tax rates are continually pressured higher. But very specifically, what we talked about back in video number 2 is that the problem with retirement is not just that tax rates are going higher, but that little bump in the green line is the real key that we need to focus on. Folks, this is a simple illustration that I gave for someone who said they needed $150,000 a year in retirement. I tried to give them a modest 2.5% bump every year for inflation and show the resulting taxes that would be paid. The green bar represents the taxes paid, but the question is, why is it not a smooth ascending line just like the income line is? And that's because of the IRS rules regarding required minimum distributions, or RMDs. Remember back in video number 2, I said that RMDs start for everyone at age 72. And what that means is that at age 72, the IRS requires that you withdraw a minimum given amount from all of your retirement savings. That could be IRAs, 401ks, or other forms of qualified retirement accounts. Folks, that additional requirement means that you will be paying additional taxes starting at age 72. Well, the key question is there anything I can do about it now as I'm getting ready to think about retirement or I'm in retirement? What are the options that allow me to recognize some potential tax savings? Now, remember, the tax problem comes because you've done your job. You've saved for retirement. You've got a healthy retirement savings account, whether that's in the 401k or in an IRA. You have to remember that any distribution you take from either one of those accounts is treated as ordinary income. Now, what is ordinary income? Remember, that's the IRS term for salary, wages, or other income that applies to the marginal bracket system. So simply put, the more you withdraw from your retirement savings, the more taxes you're going to pay. One of the problems we talked about when it comes to retirement is how the IRA, as it continues to grow before age 72, just creates a bigger and bigger tax problem. And the question I posed was, is there anything you can do about that to try to manage the size of the IRA before you get to age 72? And we had 2 potential solutions, one of which I just spoke about in video number 4 on using NUA. If you remember, NUA is the option allowing you to take company stock out of your savings plan, not even go to the IRA, but go straight into some form of after-tax brokerage account, allowing you to recognize some very significant tax savings. If you didn't watch that one, go back and watch video number 4. It's important. What's key about this is that these are things most financial advisors will not talk about. And the reason is because these are situations that require input from a tax professional. They will generally tell you that they can't give you tax advice, that you need to go find a CPA that can do that. But the problem is, if it's not a CPA that's familiar with retirement or works with this financial advisor, they may not know the answers either. That's why at Engrave Wealth, we employ both CPAs and CFP, certified financial planners, so that we can work together to think about not just the investing side of retirement, not just the cash flow side of retirement, but also the tax side of retirement. And what we're going to talk about today is a strategy that our CFPs and CPAs have put together that helps our clients minimize the reach of the IRS into your retirement savings. How do we do that? Well, simply put, we are going to think about the idea of using a potential tool that allows you to move money from an IRA into a Roth IRA using something called a Roth conversion. Now, here's the hard part. When we talked about NUA, I said the challenge of NUA is it's a one-time event. One time, you have the opportunity to minimize taxes by taking company stock out of a 401k, moving it into an after-tax brokerage account. Once it's done, it's done. You can't go back and do it every year. With a Roth conversion, though, we can exercise Roth conversions at any time we want. Now, I know what some of you are saying. I already had somebody tell me that their financial advisor told them they don't want to do this because they can only do $7,000 a year. That's the a Roth limit of $6,000 per year plus $1,000 over age 50. But the problem is that advisor's confusing a Roth contribution with a Roth conversion. They are two, in fact, very different things. A Roth contribution basically says that anyone who has earned income can put money into a Roth IRA up to $6,000 per year. And if they're over age 50, you get an extra $1,000, making it a $7,000 a year contribution. Most people look at that and say, hey, it's nice, but it's not going to make a big difference in the long run with my retirement. I'm actually talking about something entirely different. A Roth conversion is a separate rule that the IRS allows, which means you can convert any amount of money from an IRA into a Roth IRA at any time you want. Even if you're still working, you can convert money from an IRA into a Roth. Now, this is important, and it's going to create a lot of nuances and confusion that you need to know about. So I want to get into the details of how this works by sharing with you an example of how we would evaluate how much of a Roth conversion you should do. Somebody might come in and say, well, look, I'm retired and I like the idea of the tax-free income from a Roth IRA, so I'm just going to convert 100% of my IRA into a Roth right away. Well, that would be a big mistake. And the reason is you don't know the nuances of conversions, which says that every dollar you convert from an IRA to a Roth is taxable as ordinary income. Now, before you think that, well, this is not applicable to me at all, then I do want you to know that there are actually some extremely helpful strategies using Roth conversions in moderate amounts each year. How much should you convert each year? Well, it largely depends upon how much income you're already recognizing and how much in taxes you're willing to pay. We're going to run through this example to help you see exactly how we determine that so that you can know the benefit of Roth conversions in your overall tax plan. So let's start off by looking at the 2021 married filing joint tax brackets. These are the marginal brackets showing for every amount of income you get, how much in taxes you pay. Now, keep in mind that the marginal tax bracket system is a compound system, not a simple system, which simply means that you are paying tax on the first 10% of income at a given level. You're paying 10% tax on the first amount of income up to the $19,900. And then the difference is between $19,900 and $81,050, you're paying 12% tax. And then from $81,050 up to $172, you're paying. So you understand the complication this creates. With every amount of income you're getting, there's a different tax rate. It's important to know basically how much income you expect to recognize. For someone who's retired and comes to us and says, well, I'm going to start off knowing that I'm going to recognize about $75,000 a year of taxable income, whether that's from Social Security, additional work, consulting work, or just money they're withdrawing from their savings, retirement savings. They can come and say, hey, I know I have taxable income of $75,000, which we know puts them in a 12% marginal bracket. So how does this work with a Roth conversion? Well, essentially what we want to do is we want to build a hypothetical scenario that says, over and above the $75,000 of income you're already recognizing, what if we did a Roth conversion that took you all the way up to the limits of a 22% marginal bracket? Now, you're going to look at that and say, well, that's more taxes. That's true. But think about this. What we're basically doing is we're recognizing taxes that we would otherwise be paying after age 72 with RMDs. If the money's already in an IRA or a 401k, you're already going to be taxed after age 72. What we want to do is remove the minimum distribution part of that and make it somewhat more manageable. So in other words, if we said, what if we did a conversion up to the 22% marginal bracket, meaning that you're going to recognize more income, taking money out of the IRA, moving it into the Roth, getting that future tax-free growth? Does that make sense? Does the additional tax help you today versus what you'll be paying somewhere down the road at age 72? Further, let's go one more and let's talk about what if we did a bigger Roth conversion? What if we looked at converting somewhere around $200,000 to $250,000 of additional IRA money or 401k money and move that into the Roth? Again, now I'm talking about a much larger tax bill, but does it make sense when I compare the taxes I'd pay today at today's lower rates compared to what I'd be paying later at higher rates potentially? And then finally, let's go ahead and run the 32% bracket and see what that does. And why in the world do I want to run these different scenarios? Because what I want to be able to show you is the impact of moving money out of an IRA earlier so that we can reduce those later distributions from the IRA for required minimum distributions. What we try to build is a scenario that looks something like this. Every one of our clients is going to get an Engrave Wealth Retirement Optimizer. And that optimizer looks at your base case scenario. What if you did no Roth conversions and you simply had money in the IRA that was going to be distributed as an RMD, required minimum distribution, and you were going to pay ordinary income taxes on that distribution? What we're showing here is that at age 95, assuming a very safe 5% annual growth rate on your investments over the life of your retirement, the ending value of your retirement savings in this particular example was $1.35 million. That consisted of a $528,000 IRA and an $817,000 brokerage account after tax. Now, where does that come from? What that comes from is the assumption that at retirement, you had a given amount in your IRA that would be subject to RMDs at age 72. Those RMDs are going to be taken out and put into the blue bucket being your brokerage balance. Keep in mind for this example, we've already accounted for the expenses that you need in retirement. We've accounted for the inflationary growth of 2.5%. And at the end of the retirement phase, at the end of life, you still have $1.35 million on this base case example. The key is this: on those required minimum distributions, we recognize that at today's tax rates, you'd be paying approximately $546,000 of taxes over the next 30 to 35 years. So assuming during the course of your retirement that those taxes are going to be paid at today's rates because of your RMDs, you're looking at a scenario that might be able to be improved upon. How? By executing these Roth conversions. With the Roth conversion, we are going to consider doing Roth conversions during the rest of your life up to the 22% marginal bracket. That 22% marginal bracket means that we're going to be taking money out of the IRA, moving it into the Roth IRA where you get future tax-free growth, and recognizing that you still get your income needs met, your expenses are still paid, and we're accounting for 2.5% inflation. Folks, by simply focusing on the 22% marginal bracket Roth conversion strategy up until age 72, we can increase the total value of your plan by roughly $200,000, giving you $1.53 million at the end of life, age 95, rather than the $1.35 million. Again, simple 5% annual growth, understanding the impact of making these Roth conversions. We've lowered your overall tax liability by roughly $125,000. Now, again, I'm looking at numbers way out into the future using a discount method, taking them back based on that 2.5% inflation rate to show you this is in today's dollars. Okay. The impact of inflation means these numbers will be bigger by the time you're 95, but helping you see on a relative basis what that's worth to you. We're using net present values to show you in today's dollars what would this plan be worth? Understanding the benefit of a 22% marginal bracket Roth conversion strategy is a major form of tax savings. What if we kept going? What if we did a 24% Roth conversion strategy? Remember, we're going to convert even more money up to the 24% bracket in those early years of retirement up until age 72. What does that do for you? Well, it still increases your overall net worth. At age 95, your estate is now worth $1.45 million, but the tax savings are even more extreme. In fact, we've now breached $150,000 of potential tax savings simply by recognizing the ability to do additional Roth conversions earlier in your career, earlier in your retirement. Now, why is the total value of the estate worth less on a 24% bracket than on the 22% bracket? Well, simply because the bigger Roth conversions that we're doing under a 24% conversion strategy result in more taxes paid in those early years. That's a cost of doing the Roth conversions, which ultimately costs you a little bit more money in the overall strategy. Is it worth it? That's hard to say. For the individual that we built this plan for, she had one additional important consideration. She wanted her children to inherit a tax-efficient retirement portfolio when she's gone. One benefit of her strategy is the green bar is bigger at age 95 for her than either the blue or the red bar. Why does that matter? Well, the green bar represents her Roth IRA. We converted more money into Roth while she was still under age 72, allowing that Roth money to grow. That means, again, she had a form of tax-free income later on in life, but more important to her, she had an asset that could be inherited by her children tax-free. You see, back in video number 2, we talked about the Roth IRA as a strong tool for future tax-free income. What we also mentioned, however, is that the Roth IRA is a better investment to inherit for your children. When you think about the strategy of a Roth IRA, the Roth IRA must be distributed to children once you're gone, but it can be distributed tax-free. Folks, extremely important to remember, the benefits of Roth IRAs go way beyond tax-free income. And in this case, it gave her a better tool. Now, we ran this for another client that looked at a portfolio starting from a much higher level. And I wanted to simply show the benefit of using higher dollars here and engaging in a multifaceted conversion strategy. What if we needed to convert money from an IRA some years at a lower bracket and later years at a larger bracket? What we considered for this individual is doing Roth conversions after 2025. What's so important about 2025? Well, you may or may not realize that today's current tax rates were built in 2018 with an expiration date. The Tax Cut and Jobs Act, passed back in 2018, was designed by Congress to basically disappear or sunset, if you will, in 2025. At the end of 2025, we go back to the 2017 marginal tax brackets. That means that this individual converting funds after 2025 is going to see tax rates at 25 and 28%. Again, simply showing the different options, we can see the choices for tax savings as well as Roth conversions really do add up over time. Looking at this individual, more than $500,000 of potential tax savings simply by exercising an aggressive Roth conversion strategy here today. Folks, if this is something your advisors never talked about, there's a reason. The tax implications that come off of this are very complex, and they require a tax expertise when looking at your retirement savings to understand what's going to be in your best interest. I strongly encourage you, if you have not done this before, start off by looking at some of the basic questions, answering those things like, can I even afford to retire where I am right now? Or how much income could I generate off of this retirement saving strategy? What about these Roth conversions and NUA that you talk about? Folks, retirement optimization and your personalized retirement analysis answers all of those questions. This analysis is designed to be free of charge with no obligation to you, because everybody needs to understand the importance of retirement planning in the early years of retirement. By collecting some basic information from you, we can build out an analysis like this within 1 to 2 business days, schedule a time to visit with you over Zoom or in person, and share the analysis with you so that you will know exactly what your obligations are and what opportunities exist for you to generate some potential tax savings. Folks, if you want to get started on that, head over to the website at engravewealth.com. Click on the button that says start your free analysis. We'll collect some basic information from you. You can securely upload some personal documents so that we can build this analysis, and we will be able to provide for you that tool, helping you answer those questions for you and your family. Folks, thanks for joining us for these videos. Stay tuned. The next video, number 6, is going to give you a sample of what that personalized retirement analysis looks like and how it can be of benefit to you and your family. Thanks for joining us. We look forward to talking again soon.